All right. We just had one more person join, but in the interest of time, let's go ahead and get started. My name is Liv Benger. I am the Director of Programming for IntEnt. We are a Boston College graduate student organization providing mentorship, experiential learning, and collaborative resources to BC graduate entrepreneurs. Throughout the year, we'll be hosting presentations and workshops. This is our first event of this academic year and our very first all virtual workshop. So welcome and thank you so much for taking the time to tune in. Just a couple of housekeeping things before I introduce our speaker. We will leave time at the end for questions. So because it's a smaller group, you can just unmute yourself, or if you'd rather type your question into the chat box, I can read the questions at the end. And just know that this is being recorded for IntEnt's YouTube channel, and I'll send out a link to that at the end of our session. So tonight we have TJ Mahony. He is my boss and partner at Boston-based venture capital firm Accomplice. Since he is an entrepreneur turned investor, he's very familiar with both sides of the startup fundraising process, and he's here to share a bit about his journey and the various ways you can raise capital for your business. So without further ado, I will pass it over to TJ.
Awesome. Thanks, Liv. And I am not Liv's boss. I work with Liv.
Okay, fine.
She just helps me a lot more than I help her. So Liv, do you want to, and that's my Swiss Mountain Dog. Do you want to put up the presentation so I just have some structure?
No.
And as you guys know, I am at home and I have children, small children, and a massive dog. So there's going to be background noise here that I will not be able to manage. Funny startup. So next slide. So a little bit of background about me, guys. So I grew up in Colorado, went to school in Minnesota, moved out to Boston when I was 22, worked for a couple startups, and then started my own business. And then after we sold that, I turned into an investor. I will say this, through my entire professional journey of I've had different roles as a consultant, as an entrepreneur, as a CEO, as a product person, as an investor, all this stuff. Like every journey is different. So anyone who gives you a prescribed kind of path, you should ignore. You will figure out your way in your own time and through your own mechanisms. And so I'm going to take you through a couple different sources of capital you can begin thinking about. But before we do that, next slide, Liv, I'll just give you the quick FlipKey Journey. So I worked at a company called Compete. Compete did competitive intelligence. We collected clickstream data from millions of internet users, and then we used that to predict what people were doing online, how many people were buying things on Amazon, or which types of car models were going to get bought. So in that, I got really good at understanding like consumer trends. And at one point in time, I was traveling so much, and I just bought my first condo. I realized I did the math on how many nights I had slept there, and it was costing me $350 a night to sleep in my own apartment because I was never there. So I was like, I should either just live in a hotel or I should turn my condo into a hotel. And so I started Airbnb-ing or FlipKeying my place 2 years, actually this was 3 years before Airbnb was ever created. And people would book it. And I would come home from business trips and there would be $1,000 check on my desk and a bottle of wine and a thank you note for being such a good host. And I thought, this could be huge. You could change the landscape of real estate and travel and economics by allowing people to start renting out their most valuable asset, which is usually their home. So anyways, I convinced one of my lead engineers to resign with me. And I pitched him on this idea of this like kind of peer-to-peer rental network. He loved it, and we resigned, and we started working on FlipKey. Actually, I don't know what comes next. Can you click something? Oh, so the first thing that we did is we went to Angels and Friends and Family. F&F stands for Friends and Family. And we put together a convertible note. Later on, if you guys want to ask me what a convertible note is, we can get into that. But basically, it's a very simple mechanism where people give you money now, and it converts into equity at a later time. And I believe we put a cap which is basically a valuation of $4 million on it. And we set out to raise $500,000. And we must have collected 30 different $10,000 to $25,000 checks. We had a couple people give us $50,000. And I want to say 50,000 was the largest check that we got from anybody. But what was important is we also got some notable people to give us checks. I got a couple of VCs to personally give us checks. I got early guys at Google to give us checks. I'm forgetting. Oh, and Jeremy Allaire, who was an alumnus of my undergrad, and Jeremy's quite famous. He was the CEO of Allaire Software, which became Macromedia. He basically invented Flash. He's now the CEO. He started Brightcove, which is a publicly traded company. Now he's the CEO of Circle. Anyways, he's like a totally decorated CEO, and I got him to get involved. So I had a roster of people that gave other people confidence that I wasn't a total clown and that I might know what I'm doing. And we set off to create this company. Next one. So after we did that, we started building out the site, and $500,000 will not get you very far. So it was our ability to get some traction, to start building a semblance of product and team. But ultimately, we were going to need millions of dollars to go after this idea. So we started taking VC meetings. And because of the roster of angels that we had, and because of somewhat of my background, I was able to get a meeting with almost every VC in Boston. And everybody had me in probably 3, 4, 5 times. Everybody was interested, but nobody actually gave us a term sheet. They just kept hanging around the hoop. They wanted to, they wanted to see something magical happen before they were willing to give that check. So during that time, I started writing research papers. Remember, I came from a company called Compete that does competitive intelligence. So I had, through my past employer, I had access to very valuable data that most companies pay millions of dollars to get access to. So I bartered with them and gave them some free consulting services in exchange for giving me access to the data. So I used that data to publish the first research reports in the history of the vacation rental industry. And then I hired a designer, and I made it look all nice to make it look like we were a very professional shop. And I sent that out to the world. And I sent it to every property manager and every corp dev person in the travel industry, and pretended that they had signed up for it. And I woke up the next day, and I will say, I'm going to brag a little bit, but it was a good report. It was the first report ever, but it was super insightful. It was data no one had ever seen before. And it was the first report ever that basically said the vacation rental industry is massive. And it could be even bigger if you were to grow it and open up access points. And I woke up the next day, and I shit you not, I had emails from the heads of corp dev from Expedia, Priceline, Hotwire, Hotels.com. I down the line, because this is a category, their job is to always be strategically kind of embedded and invested in what's next, to de-risk their business and to grow their business over time. I also had emails from a bunch of property managers in the vacation rental industry that wanted to know what we were doing and work with. So I started taking some of those calls. And ultimately, and Liv, next one, Expedia Corp Dev was really interested. And they were most interested because our business looked a lot like, we had actually branded FlipKey as the TripAdvisor of the vacation rental industry. Because prior to us, if you looked at any kind of listing sites out there, all you could see was homes that were for rent, but there was no verification, there was no guest reviews, there was nothing. There was no third-party validation at all that this was real. So fraud was rampant. And so we fixed all that. We built this system that basically created verification and verified guest reviews and all of that. And we called ourselves the TripAdvisor of vacation rentals. So Expedia called and said, well, we own TripAdvisor at the time, and they kind of want to get into this. And what are you going to do? And when TripAdvisor starts getting into vacation rentals, you can't call yourself the TripAdvisor of vacation rentals anymore. So anyways, we had some deep discussions, and after 6 months, they made a strategic investment. That strategic investment is a little complicated, but they more or less they gave us $5 million of working capital. In addition, we had exclusive rights to power the vacation rental tab on TripAdvisor. And they in turn got the majority, they basically controlled the majority of the business. But we still maintained, overnight, it turned the value of our company from arguably zero to tens of millions of dollars if we could execute. And ultimately was worth hundreds of millions of dollars. So we set off on this journey of basically working with TripAdvisor over 4 years, building out both FlipKey, but also building out our integration with them. And at the end of this 4-year strategic partnership, there was a mechanism where they had to buy the remaining minority shares through a process that I'm not going to get into on this call. So we were acquired by TripAdvisor. So ultimately, we had a venture-like outcome, but we never actually like raised venture capital money. So my prior company, Compete, had raised $50 million of venture capital money. Through FlipKey, I learned a lot about effectively raising from angels and friends and family. Learned a lot about VCs in that process without ever actually going forward with one. And then went through this strategic corporate development process. Coming out of that, I made a little bit of money and began doing angel investing. And in doing that angel investing, I started spending more time at venture capital firms, but more as I held the title of EIR at one point, which stands for Entrepreneur in Residence, where they were waiting for me to start my next business. And then my next role was more as a venture partner, which was sitting in a different office and making investments on their behalf. So then I became a venture capitalist, and I started evaluating deals and meeting kind of the mini-me's of the future and having to evaluate and determine if I was going to invest in them or not. And through this, of my companies, like just when I invest in a company, it doesn't mean that all their money is going to come from venture capital moving forward. Like you end up actually, every company ends up taking money from an assortment of different categories, which I have a really crude chart next that I'll kind of take you through that. So I come from more of a venture background, venture being companies that are typically driven by software technology, certain kind of hard science hardware. But the majority of businesses are not venture scale businesses. So I'm going to take you through this and actually also highlight the types of businesses that this type of money is actually good for. So angels, friends, and family, that's good for anything. You get people to buy into what you're doing. It could be for a software company, a hardware company, a restaurant. I put angel money into a company that makes these fucking things, collectible toys. And so it can be anything. Bank loans, where you go down to Bank of America or Santander or whoever your local bank is, they are not looking to invest in new businesses with no money. They will put money into collateralized businesses where you have something that's of value, and that thing of value is liquid, meaning that they can go out and they could trade it to somebody else to get their money back as fast as possible. In addition, the business that you're running has somewhat of a predictable path to cash flow, which in the venture world is typically years out. You might not actually have any type of positive cash flow for 5-10 years in some cases. So the businesses that this qualify for: restaurants, car services, real estate. Remember, it's things where there's a hard asset that the bank can actually take away from you if you fail to pay on the loan, and then that thing can pay them back most of their money. Venture capital, like I said, these are technology-driven businesses that can carry a market value of over $1 billion. Like locally, good examples: DraftKings, Wayfair, Klaviyo, HubSpot. All of these companies are worth multiple $1 billion. But all of these companies started with 1 or 2 people in a garage, no money, angel investments, and really, really rocky starts. But you look at what they were doing. Like DraftKings wasn't going out and trying to create daily fantasy sports. Like not at all. It was a loophole for them to begin building a gambling business. And they were very clear with that. Wayfair wanted to be the Amazon of furniture, like that's worth over $100 billion marketplace. Klaviyo is automated marketing and e-commerce. E-commerce is $1 trillion category. Like that is not a small business. And so venture capital has to be matched with massive ideas and with teams that can execute on those massive ideas, which is why very, very few, like less than 1% of people that go out there to try and get venture capital money actually get it, because it is a very, very tough filter to qualify for those checks. Once you do get venture capital, though, you automatically qualify for venture debt. Venture debt is by other banks that will lend uncollateralized money to companies, but they're doing it basically because of the endorsement of the venture capital firms that have already put money in. These loans tend to be expensive. Venture debt is in the double digits typically, anywhere from 10 to 20%, almost like a credit card. There are a few banks that will lend more at like the 6 to 7% rate, but venture debt is very expensive, but it's non-dilutive. They don't take any equity off of you. So if your business is predictable and you're confident in it, entrepreneurs are better off taking debt than they are selling equity, because the equity is worth more in the long run. And so now I'm getting more into like, you've started this company, you have the semblance of an operating, and you've taken money from some category, and now you start getting into more alternative financings. And the first and one of the most flexible on alternative is family offices. Family offices is a term for rich people's private offices. When I say rich people, I mean not people who are worth $10, $20 million. I mean people worth billions of dollars that actually have private staff that manage their money for them full time. Like they don't work with Morgan Stanley. They work with a guy named Bill who literally has an office that just works on your deals and your money. Family offices often, like, they get inspired sometimes to be part of more kind of higher returning software to, technology like investments. But sometimes they also are just interested in local things that sound interesting to them. So as a example, I was the original investor in a company called Love Pop. You might know them. They're a Boston company. It is, here's one, 3D gift cards. They're cards where you open them up and then there's something that actually pops out of them. It's actually kind of complicated how those cards are made. And they do other things. I don't have them here, but they make flowers and all this stuff. Anyways, it is a large business. It's a business that will do over $100 million next year. We have funded it. Other venture capital firms have funded it. They also have raised tens of millions of dollars in venture debt. So, and they originally started with friends and family money. I was part of the original friends and family round. I was not a friend or family, but I was an angel. It was, I think, a $400,000 raise. And then after that, they raised venture capital. After that, they raised venture debt. And then we got to a point where they needed more money, but it was harder to raise venture capital money. We had maxed out our venture debt. And we found a local, very wealthy family office that invests in a lot of businesses locally and also internationally. And they loved the product. They loved the fact that it was Boston-based. They loved the profitability profile, and it just fit their model. And we raised another $10 to $20 million through this family office. Family offices there's not like a directory of them online anywhere. How you get access to them is typically random. In this case, a friend of a friend introduced us to this family office, but they're out there. Next is you begin graduating to private equity. Private equity tends to focus on, actually historically, private equity tends to invest in businesses that have not raised venture capital money. They look at businesses that have been built on a shoestring budget. There's no dilution. The owners own next to 100% of it. They've been doing it for 10, 20 years. It's worth maybe $200 million, but could be worth $1 billion if it was just run by a group of operators that want to go faster, and they will go in and they will make an offer to buy out that business. More and more, we're starting to see private equity also begin to invest in venture companies, where they will come in much later stage and they will want to buy out a third to half of the company. But again, to do the same thing, buy out a lot of the existing investors and a lot of the founders' shares, buy a majority stake of the company, and then help it grow a little faster, a little more profitably, so that they can then sell it. Private equity is there purely to ultimately sell that business. Sometimes they're able to get it to IPO, but in most cases, these are funds that are trying to liquidate their assets every probably 3 to 5 years. Or venture, we are on a cycle of like 10 to 12 years, so much longer time horizon. I already went through strategic corporate development, but often when I see entrepreneurs that are building something that's a very interesting business, it does some very specific function or feature type of activity, I'll tell them, like, this is really cool. I'm not sure it's a company though. You might be building a feature, and it's a feature that McDonald's will really like, or Salesforce, or Wayfair, or TripAdvisor. And I'll say, you should go and see if they want to invest in it. Because all of these folks have, either it's the executives or they will actually have a corporate development arm that want to make investments in that type of thing. And so typically by taking a strategic corporate development check, you will limit your ceiling. The reason they're making that investment is typically to have an option on your business, meaning that they will buy you in the future, or they will choose not to buy you, which in itself is kind of an outcome because it might mean that you're going to die. But it is not the first place you should ever seek a check, but they exist and you can pursue them when it makes sense, or they will be pursuing you. And last, and this is a business that I've learned more about in the last few years, because there's a lot of new services and companies that are offering this, is factoring. Factoring is only relevant for companies that actually have products that are out in market and more or less have accounts receivable coming in. So, or inventory. So you're an apparel company and you have $1 million of inventory. I can basically collateralize that inventory, and someone can loan me $500,000 to be able to market that inventory and sell it. But I'm basically financing the company with the shit that I already have. And the instances of like professional services, I am an attorney, or I do design work for somebody. And ultimately, I have performed services where people owe me $200,000, but it's 60 days net, meaning they don't have to pay me for 60 days. There are services where I can go and say, listen, they owe me $200,000. I will give you those accounts receivable. You just give me $170,000 of cash now, because I would rather have the cash now, and you collect that shit when it comes in 60 days. So there's a lot of industries, even software now is starting to do factoring, right? So if I'm a SaaS company and I have $1 million of ARR, and I know it's contracted, these companies pay me, they've already agreed they have to pay me $10 a month for 12 months. So it's in the bag. I have this predictable ARR. There are companies that will prepay me for that ARR, so long as when my clients pay, I give them the full amount. And so again, once you have momentum, you can actually take the assets, whether it's hard assets like inventory or real estate or whatever it is, or more future assets, which is cash flow, and you can get people to give you money, collateralizing those things as assets. Liv, do you want to go on to the next slide? So my advice, actually just go through all of them so I can just bang them out. So, not perfect. So I want you guys to be able to ask some questions, but in my journeys, I will say, as both an entrepreneur and now as an investor that evaluates entrepreneurs, ideas are not valuable. People who do not share their ideas with me because I haven't signed an NDA, or they think that someone could steal their idea, I'd say almost 100% of the time, that company or idea never sees the light of day, because it's not the idea that matters. It's the execution, the team, and the persistence to like achieve. Persistence are, I don't know what that was originally supposed to say. Anyways, So my world of VC, if you think you want VC dollars, be very comfortable defending that you are a venture scale business. Chances are you're not. These are the majority of my no's when, and again, I say no to 99% of the people that pitch me. And that's not, by the way, me dismissing their business. Most of the time, it's me saying, I don't think that what you're building right now is actually big enough for the type of business that we are in. We have to take very high risk opportunities, but they can only be justified by extremely, like, exceptionally big outcomes. So I would rather take a 0 on 9 of 10 investments and have one investment be a 100x. So if you present me a business that has a clear path to have a 4x return or 5x return, but that's kind of the only outcome, like it really couldn't be much bigger than that, I have to say no. Even if you guaranteed it, even if it was 100% chance of that being the outcome, we would still say no. We have to justify a 100x type of opportunity. I will say the happiest people on the planet and the happiest entrepreneurs do not take VC dollars. Once you take VC money, you are on a different path. You are on a get big fast or die. And that is just how these pipes are built. And it's for the people who want to build big businesses fast. If you are passionate about what you do and you want to do it the rest of your life, chances are you should look to raise money through other alternative kind of channels and slowly grow your business over time. Before you know it, you'll be big enough where you could probably get banks and private equity companies to give you hundreds of millions of dollars to go faster. And those are the happiest entrepreneurs. There's a site called Indie Hackers for anybody out there that's interested in like software businesses that shows it's journals and stories and kind of a community of people who build side businesses where they build totally independent, self-funded nights and weekend projects. Some of them are $10,000 a month type revenue opportunities. Some of them turn into multi-million-dollar businesses that people just independently built, and they go through and they tell you how they did it, how they never had to take money. And I'd encourage you to understand that side of the world as much as you also understand the more headline-driven VC part of the world. I already said majority of PEs doesn't take money. And no matter what, whether you become an entrepreneur or investor, get creative. People like me that tell you how I did things, you should challenge yourself to do it in a totally different way. Like, you know, derive lessons and derive frameworks from other people's experiences, but always try and figure out how to do it your way. And the stars align, timing's right, and amazing things will happen. But it takes time. So persistence is probably the number one trait of anything. So I will leave it at that. It looks like there's a handful of people on here, and I'm happy to take questions.
I have a question that I think someone sent it privately in the chat, but Crystal was asking, what are some of the knowledge areas you've invested in or prefer? For instance, technology.
Knowledge areas. I'll say this, the things that you know the best, you don't invest in because you know them so well, you know how hard it is. You have to have almost a little bit of ignorant bliss to make investments. So I would say the areas that are best are where I know a good amount, but not a ton. And I have just enough knowledge gap to ignore the clear danger zones that exist. And then I will just pray that the entrepreneur figures those things out. Whereas I've never made another investment in the vacation rental industry. I've only made one in the actual travel industry, because the travel industry, after being in it for 6 years, it's so hard. It's so hard. And so someone could have a brilliant plan and a brilliant team, and I will only be focused on all the things that'll go wrong. But somebody walks in with something that I know a little bit less, and I just start thinking about all the things that can go right. So that's how I think about it. So don't pitch me a travel business, because I'll say no.
Have a really good one.
Yeah.
All right, guys, anybody else? Don't be shy.
TJ, it's Ed Lallier. Awesome job. This was a fantastic presentation. Question: when trying to, you know, ascertain market value and just kind of pitching it and such like that, I have friends who say, "Hey, go to VCs and just kind of don't don't go in there expecting money, but go in there just for feedback." Do you find that going through the circus of just talking to different VCs and getting feedback, building that network, is that is that worth our time? Do we have to worry about people, wasting their time? So just curious about that.
Yeah, no, it's good. I'll say this though, that they say it's always better to ask for advice than money, because when you ask for money, they'll give you advice. When you ask for advice, they give you money. So it is, but you also do run the risk where if you come in and you don't have much of a plan and you're just there to talk, I will go out of my way to make sure that we don't have a second meeting, even if you're just asking for advice. And so like every interaction is important. And so when you go in, you need to go in with purpose, where you would sit down and remember, we have meetings all the time. We get totally sick of them. So like in your head, your timeline, you have 5 minutes to earn my respect. Then you have 10 more minutes to get some feedback. And if you are kind of done and like, hey, I don't have a ton of time, I need to get out of here, I'm pumped that we don't have to keep talking forever and ever. And if you've really piqued my interest, I'll be like, dude, stay here. I actually want to talk about this a little longer. And now you kind of have some leverage, and you're getting signaling back from me on whether or not this went well or not. So if I were doing it, I would, of course, I would get some friendly introductions. I would never cold call any VC. I'd figure out creatively how to get access. Again, I don't have a playbook for that, but just be creative. For you guys, one would be like, hey, Liv, I need to get access to this guy. You work with TJ, help me figure out how to do that. And you try to pull some personal favors. So anyways, you get in, and then you just say, listen, here I am. Make sure you have something too. I have a very good background in this. I'm an expert. I've built X and Y. I need to know, I think I can raise $500,000. Do you think will that get me far enough? It'll get me to these metrics. Is that going to be enough to make you interested? And I will happily answer that question. And I'll probably say no, but I might say yes. And if I say no, I'll say why. And then suddenly you'll understand where the goalposts actually are. And now we're having a very, you're not asking me for money, so my defensive barrier's down, because I don't have to say no to you. And I'm being more honest, and you can extract a lot of information from me. And at the same time, be very, very good at showing off, having me be impressed by some of the things and the traction that you've done. So when you walk out, I'm like, yeah, dude, I'm gonna help him. I'm gonna help her. Don't know if I'm ever gonna invest, but if he calls me again, I'll take a look at whatever he's working on. And that's what you're doing. So it's you're just strategically trying to plant a seed with, at the same time, get honest feedback without, without discounting yourself, if that makes sense.
Yeah, it does. Thank you. That was great.
And it's happened to me, dude. I've had people come in, they've given me their ideas. I'm like, it's interesting. I don't know if I'd invest in it, but you should go talk to this guy. And actually this company would use that service. I'll introduce you to them. And then they walk back in a year later and they have gone 20 steps beyond where I thought they'd be. And now I want to talk about investing. But they never asked me, they came in, they were upfront, I am not even close to being ready to have a VC type of conversation. But what I need to know is I'm doing X, Y, and Z. I think this can happen. What's your reaction? When does this become relevant for a shop like you? And if not you, are there other shops? Because that's what I'm trying to map out right now. And yeah, I'll give you that feedback.
That's cool. Can I add a second question?
Yeah.
Okay. Angel networks. What's your recommendation on, targeting them and kind of connecting? Do you just go up to their meetups? I mean, I got a lot of friends and family, and got people who are kind of like in the executive level for different shops. So, I was thinking about actually, looking at them. But, angel networks, I really haven't tried that. So, what's your experience on identifying and kind of trying that realm?
Historical angel networks are very inefficient. Going to their meetups is going to be most likely a colossal waste of time. It might be good in that you'll see the other deals that they're looking at and meet some people. Your expectation of getting checks, any kind of material checks from them should be pretty low. Even if you got it, the old school networks take forever. They work as a group. It's kind of, I don't know. It's going to be extinct pretty soon.
I'll be
There
creative.
are faster new age networks that are coming up that are these groups, but typically the way that the groups work is just like people surface deals. They say, I'm personally going to do it. They share it with the rest of the group. You never even have to meet with anybody. You just got to get to one of them. So it happens more naturally in the ecosystem. I think if I was you, the first person is like, you think about what you're building, you think about the most influential people for that category. So if it's like, this guy that I invested in, I mean, literally, like I gave $50,000 for this thing. Or no, not for that, but for the company. And the reason is like, he's building these collectible toys and he wants to create these media properties. And he got some of the most world-renowned toy designers to invest in his business. And so I was like, if they invested, like he must be legit. Like he must kind of know what he's doing. So I think that's where you start is you want, like, for me, it was Jeremy Allaire. I got Jeremy Allaire on my cap table and that was enough for everyone to take me seriously. So rather than thinking about angel networks or friends and family, like actual uncles and stuff like that, I would just be like, what is the list of your crown jewel angel? And you work your ass off to get him or her on it. And then that's how you open up is you're like, so this famous person is investing in my company and let me tell you why. And now I'm listening. Everyone's listening. Now everyone thinks that they might be missing something. And from there, things are a lot easier.
That's great. Thank you.
Do you have a hot take on Tim Ferris? Any opinion on that guy?
I've heard, I have one of his books. It's actually, can you see it up there? Tools of Titans. I've read exactly 0 pages. I've listened to his podcast one time and I only made it like 5 minutes in and I got bored. So I don't have any comment because I know nothing about the guy. Why? What were you looking for?
I heard that he was getting into venture capital recently, and I didn't know how.
Well, probably because we're thinking about Tim Ferris, right? Like, if I was him, I'd get into it because he'd get access to deals. You tell me Tim Ferris is on your cap table, I want to understand why. The dude's built all these businesses. He's built a brand for himself. He probably, along with him, and he has so many Twitter followers or LinkedIn, whatever network he uses, he endorses your product. You probably just tripled your client base, right? So yeah, he's on your cap table. So if I'm an early, if I'm him, I'd be an early stage investor and I would then get access to some really good deals. So in that respect, yeah, I'd happily do a deal or at least look at his deals. And then if one of my entrepreneurs thought that he is the type of promoter that would fit, I'd say, yeah, go after Tim Ferris. That makes sense. Love Pop, it was, we already invested and it was Shark Tank. So they were like, hey, we got accepted to Shark Tank. Should we do it? And I was like, yeah, do it. If they air you, you're going to sell $1 million worth of cards. Worst case scenario is like you go film and they don't put you on TV. But they got filmed. Mr. Wonderful put in a check. And we got, I would say, for the $100,000 he invested, we've gotten, I don't know, 10 to 20 million, maybe $30 million of free advertising out of that. It was great. So Tim Ferris, that's free advertising. I don't know how helpful he'll be. Probably won't be helpful at all. He sounds like all the things he does is usually for himself. So it's probably just free marketing.
Yeah.
Yeah.
Interesting. So who would you say that the key players are on a team? Like the people that you need
To build a business?
Yeah, or in your line of work in venture capital.
Well, for what we do, it is very unlikely that I invest in a non-technical founder. I have. Those typically aren't my greatest investments. At a minimum, a highly technical co-founder, like a split, like 50-50 partnership, like that works as well. Where I have two not very technical founders who then recruit a CTO, those have never played out particularly well for me.
Okay.
So I tend to look for, someone's trying to come in. I tend to look for obviously amazing people, really impressive technical chops, and really the references too, like wherever they've worked before or who they've started businesses with. I really need to hear from other people that, hey, I'm working, sweetie. Can you hold on for 5 minutes? It's my 5-year-old. So anyway, so technical chops, reference really well. And the last thing is like, I'm a stickler for product, and a lot of people are. Like, it either has to be in the CEO's blood or the technical person's blood, that there is this like renaissance like DNA around product and thinking about being obsessed with the product, so that it doesn't come out looking like a fucking gremlin. And so like gremlins breathe and talk and eat, but they're fucking gremlins, right? I want to see this beautiful product that works so much better than everything else out there. And I want to see you just so obsessed about that, that it bleeds through the rest of the organization, where like they care that much about what code is pushed, or I guess what the silly toy looks like or whatever. And that's it. So, amazing people, really deep technical chops, and this product DNA that bleeds through the entire organization. And then I get excited.
How much do emotions play in decision making? Like, because sure, you could end up in analysis paralysis, and you're like looking at all the, well, how accurate could we actually get? What's our actual risk here? But at that point, it might be too late, and opportunity might be in somebody else's hands. So when you make those,
it all depends. Like early stage. So how many spreadsheets do you think I look at a year?
I kind of want to go on like extremes. I kind of say like, maybe 5, and then, or a couple thousand.
For seed investing, 0. There's not a spreadsheet I look at. I look at the product. I look at the founder's background. I look at the deck, talk about the industry, have strategic discussions, do a bunch of like people that they know, do a bunch of backdoor references. Like that's basically it. You're betting on the team. It's not like, remember, it's not the idea. Like, and the numbers are probably made up. They don't mean anything. So why look at them? As you get into Series A and into growth stages, that's when the spreadsheets matter. That's when you have to dive deep. You have to understand the mechanics of the business, the unit economics. What are the triggers and the levers of the business? And so early on, like, yeah, emotion has a lot to do with it. You have to have this like visceral reaction to the opportunity and the people you're talking to. Later on, in getting growth money in, it's a totally different, that is more formulaic. That is a totally different game to play. I won't get into that right now. But yeah, like there's a business right now that just came out of YC. It's out of YC, and she doesn't have no one led her round, which is weird out of YC, which is a bad signal. She's really compelling. I really like her, like really, really, really like her. What she's doing is also exceptionally interesting. Her deck sucks. It tells an awful story. She's a terrible storyteller on paper. But when you talk to her, when her guard, like when you just have a normal conversation with her, you see brilliance in that. And so because I like her so much, and because I do think it's a big idea, despite all these other things being bad, I'm spending the next 3 days talking to her customers. I'm talking to people who she used to work with. Because I want to find a reason to justify this as an investment. and it's rooted because I really like her. But if I can't find it, I can't find it, and I'll have to walk away. But if I didn't like her and the deck sucked and she came out of YC without a check, like DOA, dude, dead on arrival.
Thank you.
Guys, in the interest of time, I just put our LinkedIn, YouTube page, and my email into the chat for you guys to just get more information. And TJ, thank you so much for speaking with all of us today. Before you leave, can you tell us one book that we should be reading this year, either in terms of career development or just something that you've read in quarantine that you've liked?
All right, so the book, this is the book I've actually been asked this question before, and I think I might always give the same answer. My favorite business book is called Viral Loop. And Viral Loop, it's just it's case studies. It's stories of the early internet and certain services that like blew up. Hotmail, Hot or Not, I don't think you guys even remember that. And a bunch of others. And so it starts talking about the concept of viral coefficients. And Silicon Valley is like built on viral coefficients. And it's a term that is not used enough. And the real takeaway there is that you think about the things that the people did to grow their services. And most of these were consumer-based services. What it really was is like they were cracking the code on acquisition. And so I sat down next to Reid Hoffman, the founder, former CEO of LinkedIn, who's now a partner at Greylock. Brilliant guy, dude. Just fucking brilliant guy. He's PayPal founder and then LinkedIn founder, probably worth billions of dollars. And so while he was running LinkedIn, he did 90 angel investments a year. So can you imagine that? Like 90 investments, which means that he took 500, like God knows how many meetings he took. So I asked him, I was like, I had dinner and I had sat next to him one time in my life. And at dinner, I said, how do you do it? How do you make so many angel investments while you're running LinkedIn? And he was like, well, it's easy. My meetings last 5 minutes. And I only ask one question. And I just say, what's your customer acquisition strategy? And if it has anything to do with paid channels, I say no. But if they have a clever response and they're thinking clever about how they're going to acquire customers, then I fund it. And that's my method. And so so for the rest of my life, I've looked at deals and I've looked at myself, and I always sit there and I say, like, how can we be more clever? Like, what is a different way to think about this problem than everything else that's out there? And so Viral Loop, I've always liked because it has these very little clever different ideas that built these services into hundreds of millions of, well, not hundreds, but tens to hundreds of millions of users. And they were just kind of just a different way of thinking about the problem. And so I just think it's a good framework for how to think different. And remember, customer acquisition is everything. You can build the most beautiful product in the world, but if no one uses it, then who fucking cares? You have to acquire customers. So and it's a really easy book. I think it's only like 200 pages. You could read it in a day. It's great. Super entertaining.
Awesome.
And that's my daughter.
That's your cue.
All right, guys. I have got to go be a parent now.
All right.
Thanks, everyone. I'll talk to you tomorrow, okay?
Bye.
Bye-bye.
Thanks, CJ.